Hello everyone and welcome to Stockbusters on TaipanFinancialNews.com. I'm Andrew McCord. Is China heading for a downfall? Well, take a look at the numbers and it seems, as the great Vizzini would put it, inconceivable. China's Shanghai market is up more than 412% over the past 30 months. Great news for the Chinese, right? Maybe not. These big gains actually have many experts throwing around the B word, and I don't mean boom, I'm talking about the other B word, bubble. Last Monday, China's central bank governor threatened an interest rate hike to take some of the froth out of the market. The market reacted in turn, heading to the downside and selling off the most it had all summer. More than 60 stocks hit the 10% down day limit, and the index fell 4.3% overall. Today, I have with me, fresh off what most would call a well-deserved vacation, Red Zone Profits executive editor Christian DeHamer to talk about what's happening in China. Chris, you're tan, rested, and ready, I hope. So tell us, is this froth a precursor to a meltdown, and do we have any room to run here?
Well, Mr. McCord, the numbers would suggest that the market is still undervalued and has plenty of room to run. The PE ratio on the Shanghai exchange is 43. Now, that might seem like a lot, and it is, in fact, a lot higher than the 18.34 PE ratio on the Dow. But the earnings growth rate on the companies that make up the Shanghai is a massive 48%. That type of growth is colossal. And you get GDP running at 10% per year, that's what we're talking about. Now, Andrew, the rule of thumb is that if you divide the growth rate by the price to earnings ratio, what we in the business call the PEG ratio, or price over earnings growth, and if that number is below 1, it's a buy.
Why is that? A lot of wannabe investment gurus teach that the lower the PE ratio, the better.
Well, a little knowledge is a dangerous thing, Andrew. Would you pay more for a company that will make twice as much next year? Of course you would. If you factor in the growth, it gives you a better value parameter. In this case, the PEG ratio on the Shanghai exchange is a measly 0.89, which is a buy.
So, would Chris DeHamer be a buyer here?
Yes. There are three reasons I'd buy the dip. The first is Chinese citizens still hold savings deposits of more than $2.2 trillion in banks. Now, this money is making just 2%. This money could go into the Shanghai exchange. Number two, many of the same companies that trade on the Shanghai also trade on the Hong Kong exchange and trade for a higher price. Now, just as an FYI, the Shanghai is reserved for Chinese citizens only. Thus the discrepancy in the two prices. There are ways to play the Shanghai exchange through funds and whatnot. But the third reason the Shanghai exchange is going up is that China is convening its 17th Party Congress this fall. The government will do everything it can to prop up the market until that happens.
All right, Chris, the show is called Stockbusters, as you can see by the sign behind me. So give our viewers an investment to stay away from. What that's going to go down? If Shanghai isn't overvalued, what is?
Well, London Small Cap Exchange is extremely overvalued. One of my 55 rules of trading is that you should find the world's most undervalued currency, a simple and effective method using the economist Big Mac Index. After you find the world's most undervalued stock market using fundamental values, then buy a proxy for the market as a whole. I like to use telecoms, brewers, energy companies, whatever the large company is on that particular market. You buy it and you wait. Today, we're going to use that old Karl Rove buzzword and flip-flop it. Right now, according to the June 21st Economist, the British pound is 20% overvalued. It's the second most overvalued currency in the world. And get this, London's FTSE Small Cap Index has a PE of 70. If you're looking for a place to stay away from, stay out of London, mate.
All right, Chris DeHamer declaring his independence from the British just in time for the 4th of July. Thanks for joining us. Come back soon, okay?
All right, thank you, Mr. McCord.
For more wit and wisdom from Chris, you can check out his free daily e-letter, American Capitalist, as well as his investment research service, Red Zone Profits. Information can be found right here on the main page of the TFN site. Until next time, I'm Andrew McCord. Thanks for joining us. Keep your portfolios safe.